Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to teach, put it in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Not that long ago, pretty much everybody assumed that the next non-tech stock to cross the $1 trillion threshold would be the stock of Eli Lilly. Why not? They've developed a weight loss and diabetes wonder drug with incredible prospects. Oh, but this market plays many tricks on us every day, including today, where the Dow dipped 126 points, S&P declined 0.13%, and the Nasdaq edged down 0.07%. The anomaly this time, it looks like the next $1 trillion stock won't be Eli Lilly. If anything, it's more likely to be the stock of J.P. Morgan, a bank. Right now, Lilly's market capitalization is roughly $724 billion, but J.P. Morgan's at just over $850 billion, up 29% for the year. Meanwhile, Lilly's down so slightly. To me, this is a monumental move, people. A bank stock putting on that kind of market cap right on the eve of an incredibly important Fed meeting, where everyone seems to be expecting a quarter-point rate cut, despite a recent uptick in inflation. What's going on here? First, to understand the $1 trillion barrier is really hard to cross. Right now, there are only 9 members of the club. NVIDIA at an astonishing 4.2 trillion. Then Microsoft close behind at 3.8 trillion. Apple at 3.5 trillion. Alphabet, which just crossed the $3 trillion threshold. Amazon at $2.5 trillion. Meta at $2 trillion. Broadcom at $1.7 trillion. And there comes Tesla again, $1.4 trillion. And at last, hanging on by a thread, is Berkshire Hathaway at $1.06 trillion. They're all more or less tech companies, except for Berkshire. Oh, I thought Lilly would be next. Look, the GLP-1s are just that huge. Today, Lilly announced plans to build a $5 billion manufacturing plant in Richmond, Virginia. As we told members of the investing club this morning, this facility marks the first of 4 American plants for targeted cancer and autoimmune drugs. They also need another plant for the pill version of the GLP-1 drug, which hasn't been approved yet, but could turn out to be much bigger than the current injectable version of the drug. When you consider all the indications for this thing, including the already approved chronic weight management, diabetes, and obstructive sleep apnea indications, and the fact that it might be approved for heart failure, hypertension, and even chronic kidney disease, well, you can see why the betting line favored Lilly to cross the $1 trillion finish line first. But Lilly's stock has been stalled, in part because it has a vicious, some would say desperate rival in the form of Novo Nordisk, which is doing quite poorly, but has a very good compound. Plus, you aren't supposed to buy drug stocks if the Fed's going to cut interest rates. They are toxic at this point in the business cycle because it should accelerate the economy, so you should avoid so-called safety drug stocks. And, of course, the president seems to be hostile to the industry. They're building plants in America. That could help Lilly. Meanwhile, like a horse that's bided its time but is now at the far turn, J.P. Morgan stock is putting on a run-for-the-roses move that's as breathtaking as it is obscure. What's propelling it? First, it's not the only bank that's making a ferocious move. Citigroup, for example, which had been in the doldrums for so long, just crossed the $100 mark. What a 43% rally for the Citigroup stock. That's a remarkable move in itself. Wells Fargo and Bank of America have been climbing, too, up more than 15% each. The so-called investment banks, Goldman Sachs and Morgan Stanley, have been running like crazy, with Goldman up 37%, Morgan Stanley up 24%. But if you ask me, the real rocket fuel, it's the expansion of what we call the price to earnings multiple, or what we will pay for the company's earnings. Right now, people are simply willing to pay more for the banks. We don't talk enough about the PE, price to earnings multiple, around here, a topic to which I spend a lot of time in my next book, believe me, How to Make Money in Any Market. Comes out in 2 weeks because it's just so darn important. See, I don't think people realize that the price to earnings multiple is at the heart. It's the fundament about how stocks trade. The multiple can rise even when the earnings estimates stay the same. That's called multiple expansion. It can move up a stock, or the multiple can stay the same when the earnings estimates rise, which gives you a higher stock price, too. In the case of the banks, it's both. That's right. Both the earnings are going up and the price-to-earnings multiple is increasing at the same time. It's remarkable because we're less than 24 hours away from a Fed meeting that would normally upset the financials if it backfires. And if you want to know what it means for a rate cut to backfire, stay tuned for the rest of the show. Right now, though, the market's saying that the Fed doesn't matter to the bank stocks, which is nuts, because the Fed matters immensely to the actual banks. Now, some of that's because of this multiple expansion I just referred to. JP Morgan stock has been consistently selling for about 14 times its earnings for many, many years, dramatically lower than the 22 times earnings bogey of the S&P 500. But it's been levitating alongside the earnings estimates all year. Now, JP Morgan sells for 15.7 times this year's numbers, up from 14. Goldman Sachs and Morgan Stanley have also been making gigantic moves. They now sell at 16.9 and 17.5 times earnings, respectively. It is what we call a wholesale revision, and it's only gaining steam. Now, kudos to Mike Mayo, the uber-bullish bank analyst at Wells Fargo, who has a terrific piece out just today entitled "Goliath is Winning." He upped his price targets for all these banks, making it very clear that the capital markets are really getting hot. With some terrific tailwinds like Trump deregulation, even credit quality, which has been remarkably good during this period. His favorite has been Citigroup, which CEO Jane Fraser has rescued from obscurity. Great call. I happen to like Wells Fargo, where Mayo toils, because CEO Charlie Scharf has resurrected this bank, this time from regulatory hardship. That said, JP Morgan's got something special. It excels at so many things, lending, capital markets, trading, and perhaps most important, statesmanship, with CEO Jamie Dimon performing at a level that's rare for any industry. JP Morgan has always been a top-quality bank, but it's now become a fantastic place to work, and its global reach is unmatched. There's a reason its market cap is so much bigger than the other major banks. Can this continue? I have to tell you, if you look at the forward multiple, meaning how much JP Morgan's trading on versus next year's earnings estimates, the answer is a resounding yes, because this one sells for just 15 times the 2026 estimates. That's puny. Goldman Sachs and Morgan Stanley trade at roughly the same levels, but Wells Fargo, Bank of America, and Citigroup sell ridiculously low, around 10 to 12 times next year's numbers. That's not sustainable. It's going to go higher. At the end of the day, the price-to-earnings multiple is the arbiter of what's cheap and what's expensive on next year's earnings estimates, and you're talking cheap, cheap, cheap. So, yeah, my original prediction will likely be wrong. Eli Lilly is probably not the next non-tech stock to cross the trillion-dollar barrier. But, man, what a way to be wrong. I'd much rather have a market led by the banks than a market led by big pharma. The bottom line, I've been waiting for years for the banks to get higher price-to-earnings multiples. They're incredibly important to the broader market. When the banks are winning, it's a terrific sign for the overall trading. Remember, this tomorrow, if the averages take a hit from the Fed because once multiple expansion starts, it's not easy to reverse. We might be okay. These are hard-fought moves, and I bet that they're just at the beginning. Julio in Pennsylvania. Julio.
Hey, Booyah, Jim. It's Julio here from Pennsylvania.
Great to have you on the show. How can I help?
Hey, I called a few months back about Target. It was at a historical low back then. I picked up some shares. I'm a little underwater, but, you know, the stock's dipping further now with the CEO transition and some tariff noise in the mix. Trying to decide what to do here. What are your thoughts?
Well, the stock's down 33%. Now, I am in a wait-and-see mode on this. Why? Because I want to know this new CEO. I want to know what he's cut out. I don't know whether he's the right guy or not. I said we have to wait and see before I would possibly advise you to think that there's more to buy. And Julio, thank you again for calling. All right, look, when the banks are winning, it's a tremendous sign for the market. Remember that tomorrow, in case the averages take a hit from the Fed. On Mad Money tonight, unsurprisingly, there was so much to discuss with Apple CEO Tim Cook last week that we are airing the next part of my exclusive sit-down from the Corning plant in Harrodsburg, Kentucky, where the glass for every iPhone and Apple Watch will be born. You won't want to miss it. Then tomorrow afternoon, we will learn the latest decision on interest rates, and with it being pretty clear that the Fed is going to start a new rate-cutting cycle, I'm going to share with you one of my biggest worries about what could happen. Plus, CrowdStrike had a bunch of announcements from its annual customer conference, Falcon, and I'm getting the latest from the company's top brass, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.